Well, hello everyone, and welcome to Tax 101, our latest series and our webinars. Today's topic is U.S. real property sales by Canadians. My name is Stephen Flynn. I'm a partner with Andersen here in Vancouver. I've got my colleague with me today, Lissa Jin.
Morning, Steve.
Hey,
I'm
go ahead.
I'm a CPA, a cross-border CPA here in our Edmonton office. My practice is in private enterprise for Canadian businesses and also cross-border individual tax here in Andersen. Glad to be here.
Thanks for joining me, Annalisa. Annalisa have something in common today. The two of us were both certified acceptance agents with the IRS. What is that? Well, stay tuned and we'll let you know more about what that is and how that can help you. A few housekeeping items for today's session. We have some polling questions, and so as an organization that is connected and has status with the National Association of the State Boards of Accountancy, we can grant continuing professional education credits. To do so, you'll need to participate in our 3 polling questions. Those are going to happen at a variety of times throughout the session, so stay tuned, watch for them, and answer promptly. We'll give you some time to answer those questions. We encourage you as well to ask your questions to us. There'll be a pop-up box in the lower part of your screen there. We'll do our best to answer those questions, and we'll answer those questions in the 15 minutes we leave at the end of this 1-hour webinar. We've got some questions that came in before as well. We'll try and get to those as well. We issue a survey every time we end these webinars. And the survey is important for us to learn how we can get better at this, to answer questions. If you have other topics you'd like to see in the Canadian-US cross-border tax space, we're happy to entertain them. A lot of these topics come from those survey results. So let us know what you think. And if you'd like to see a live transcript of what we're talking about today, there should be a CC or a closed caption button on your screen there. If you click on that, our transcript should come pretty quickly after we speak it. So just some housekeeping matters today. Our next slide there. This is what we're going to talk about today. Here's our agenda. We're going to talk about some of the U.S. Tax implications under the U.S. federal law called the Foreign Income and Real Property Tax Act. We'll refer to that as FIRPTA. We'll also talk about federal tax. We'll talk about state taxation as well. Different regime in the U.S., different rules. We'll talk about some strategies, some tips, and some things to watch out for when you're selling property in the U.S. We'll talk about how to get an identifying number when it comes to working with the IRS. If we have some time today, we'll talk about the Canadian implication of selling property in the U.S. Well, the U.S. is going to tax you on these gains. Canada, if you're a resident of Canada, Canada is also going to tax them as well. We'll talk a bit about that as well. So those are some items we'll talk about today. I'm going to turn it over to Annalisa to get us started. Go ahead, Annalisa.
Thanks, Steve. So given our Canadian winters, I can see the allure of having a vacation property in someplace warm in the US, whether that's Hawaii, Florida, Arizona, or California. But on the flip side, we are still seeing Canadians who are not US citizens or US residents who own the US real property and are thinking about selling them. And that's for many reasons. And these include increasing costs of ownership, whether that's the property taxes, so general maintenance, the foreign exchange between Canada and US increasing, also the changing US economic and immigration landscape. We're seeing a lot of changing laws and policies with the current Trump administration. Then there's lifestyle changes, whether that's retirement and they want to downsize or move somewhere else. And of course, we can't forget about wealth transfer and inheritance at death. That's also a reason for wanting to sell.
Well, and that's an important topic, Annalise. And I think one of the things we're going to focus today on income taxes, and it may be a future webinar where we can talk about death or inheritance taxes. And they're calculated and determined very differently under U.S. law. There can be federal federal death or estate taxes, and there can be state ones as well. Not every state has a death tax, but states like Washington State, which impacts a lot of our British Columbia residents here that have property in Washington State, that can apply, and they can apply at different levels and different times. And Washington State has actually changed their rules and increased the rate and increased the incidence to state tax We won't talk about that as much today, but it might be a topic for a future webinar.
That's right. So seller beware. The gain on the sale of US property is taxed at the sale at withholding taxes at US federal and state. And that's on the gross price. And then don't forget about the income tax, both from the US and Canadian perspective. And that's usually the year after the sale when you file your tax return. So there's that time lag that we were going to talk to you about some strategies on dealing with that. Next slide, please. So as Steve alluded to for US FIRPTA, that's the Foreign Investment Real Property Tax Stack of 1980. So it's been around a while. And it is imposed on Canadians who are foreign persons selling US property. And it's calculated on the gross sales price. So we got three rates here. That's 0, 10, and 15%. 0% is if the selling price is under 300,000, and there's an exception there. If the buyer confirms that they're planning to use it as their primary residence, then that's 0% withholding. But that the buyer and the seller have to know that at the time of the sale. Then there's a 10% if the price of the property that's being sold is between 300,000 and 1 million US dollars. And 15% is the highest rate. So if it's selling price over 1 million, then 15%. And that's pretty sizable. If you're looking at a property with a selling price of 1 million, that's 150,000 US withholding at source that you won't get back unless you file a tax return for a refund.
Well, and I think that's a good point, in that it's a tax on the gross, and that catches people because they can look at the sale and say, well, wait a minute, I might have bought this place for $600,000. I'm selling it for $900,000. You know, I made $300,000, and that's a great win. But why is the IRS taking 15% of 900,000? Well, the idea here is it's a tax really on the buyer and their representative to collect it on the seller's behalf, and then compel or force the seller to say, okay, we've collected more tax than we are entitled to. You now have to file a tax return to reconcile the gain, to report it to us, and if there's a refund, we'll give it to you once you file a tax return. So it's a way to enforce compliance with tax laws.
Great. Next slide, please. So continue on with FIRPTA. Again, it's the withholding responsibility is actually on the buyer or the transferee, and the title company and escrow agents are involved with it, with filing the withholding. The seller must certify their status, and if it's a foreign person, then FIRPTA applies. And there's different rates if it's owned within an entity, so that's something to watch out for. And also states. We talked about the 0 to 15%. That's at the federal level. So state rates can vary from 0 to 13.3 depending on where that property is located.
And the states will often have withholding taxes on closings. So, we talked about FIRPTA being a federal tax. Places like California and Hawaii have their own state withholding, which could be anywhere from kind of 3 1/3 to 5%, again, of the gross sales price, which normally would be higher than the actual gain, again, forcing the seller to go to the state to say, okay, I sold a property in your state. Here's the gain. The tax on the gain is less than what was withheld. Therefore, I'm entitled to a refund. And so, and unlike Canada, where we typically will file a tax return that combines the federal taxes and the provincial taxes all in one tax return, the US doesn't work that way. You file a federal return to the Internal Revenue Service, you file a state income tax return to the appropriate state tax authority, which is disconnected and is a totally separate jurisdiction and tax authority. Next slide. So some other items on this then. The income tax rates federally range here, and we've given you kind of the maximum range. 37% is the top marginal US federal income tax rate. That would apply to gains on properties if you held them less than 1 year. It's what's called a short-term capital gain, and it's just taxed as ordinary income. for many of our clients, they'll hold this property for a long period of time. So anything held over 1 year, the top federal income tax rate is 20%. The nice thing about that 20% is that's the maximum rate. The US net investment income tax, which you may have heard about, which is also referred to as the Obamacare levy. So the Obamacare levy was introduced about a dozen years ago in Barack Obama's second term. It was designed to help pay for Obamacare, the health plan in the United States. And it's a 3.8% tax on investment income, interest income, and capital gains from the sale of capital property, which can include sale of U.S. real property. But that tax will not apply to non-resident aliens or Canadians who are not U.S. citizens, who are not living in the U.S. It won't apply to them. It's just for federal tax purposes, it's the 20%. The interesting thing is when the gain is at the lower brackets, the first two brackets are zero if it's a long-term capital gain. So you'll see situations where a married couple might sell a property and maybe they've got a $200,000 capital gain. Well, when you split it between them, when you calculate the federal tax, it may be close to zero because the brackets on the first two rates are also zero. It really just depends on your deductions and your selling costs. It still compels you to file an income tax return because even though your tax rate might be zero, there's still a withholding of anywhere from 10 to 15% on the sale price, and you've got to file a tax return to get that full refund back.
Hey, Steve, I just wanted to add
Go ahead,
something
Ed.
there. So usually when if there's a jointly held property and one of the owners is a US person, a US citizen, and the other owner is not, they both have to file. There's no joint filing here for the US, so there might be FERPTA on one, and then they have to file separately. So sometimes that catches some people because they just think only one person files. But if it is joint ownership and the withholding matches that, then something to watch out for.
That's a really interesting scenario. I've run into this a few times where you have Canadians selling U.S. real property. They may live in Canada, but if one of them's a U.S. citizen, you're absolutely right. For the U.S. citizen, they can represent to the buyer that I'm a U.S. person. Therefore, you don't have to withhold the FERPTA on, let's say it's 50-50 ownership, their half of the sale because they're a U.S. person. They got to represent that at closing. The owner who's not a U.S. person, you would withhold FERPTA, and so there would be a withholding tax. You have some choices under U.S. law in that situation. Normally, you wouldn't file a U.S. tax return if you're a non-resident alien, even though your spouse may be a U.S. citizen. But if it made sense, you could make a choice or an election under U.S. law to actually file jointly. And you may want to do that in certain circumstances. It really depends on the facts and circumstances. You're looking at the calculation of tax. We actually did that a couple times over the years when we realized that the US tax might be higher than the Canadian tax, and we wanted to do something to lower the US tax, and finally making that election under US tax law and filing jointly made a lot of sense for us. It's very unique situations, and you can sometimes come up with some very interesting results. One of the things we often get asked about is a Canadian will be talking with their neighbors, their friends in the US. They'll look online, they'll say, you know what? I can actually buy a replacement property. We're going to buy a bigger property in the US or a smaller property or in a different location or whatever it is. And if you can buy it within 6 months and it meets the replacement property rules in the US, you can defer the federal tax and oftentimes defer the state tax on that gain until you sell that replacement property. So a lot of people in the US will do that because they don't want to pay tax now. They want to kind of kick it down the road. They're referred to as 1031 exchanges under US tax law. 1031 is the name of the Internal Revenue Code that applies. And so you hear that term from time to time. The concern we have with Canadians trying to use 1031 exchanges and defer the tax is that Canada doesn't have a similar rule. And what you're always trying to do in an international tax environment is to, if you're going to pay US tax on something, you want to pay the Canadian tax, you want to time it so that you're paying the US tax in the same year you pay the Canadian tax on that gain. because you can use what are called foreign tax credits in Canada. Basically, if you pay $1 of US federal or state income tax, you can reduce your Canadian tax by that same dollar, but you got to have that transaction or that tax paid in the same year of sales. So the problem with 1031 exchanges is if you sell a property and use the 1031 exchange, let's say in 2025, and let's say your plan is, well, we'll defer the tax for 10 years and we'll sell this replacement property in 2035. Well, that's great. You've deferred the US federal and state tax until 2035, but your Canadian tax on that gain is due in 2025, and you won't be able to reach out 10 years down the road for any tax you pay in 2035 to use as a foreign tax credit against the Canadian tax you pay in 2025. Result of all that, you're going to pay tax twice on the same gain. Once in Canada when you sell, and once 10 years later when you sell that replacement property. So in general terms, we discourage Canadians from entertaining a 1031 exchange simply because the tax rates over time are going to be a lot higher. You're not really saving anything. We talked a bit about withholding taxes usually being higher than the final liability and the need to file tax returns. One of the things that's of quite a bit of interest over the last month or so is changes proposed in US law. And a lot of you have read about something called the Big Beautiful Bill. And this is a comprehensive sweeping tax law change in the US that has passed the House, albeit narrowly, and is currently being debated by the US Senate. And the goal is to, within 30 days or by July 4th, for President Trump to sign this proposal into law. One of the provisions in it is called Internal Code Section 899. Now, 899 has been around for easily a century. It's rarely been enforced. I was reading about this in sometime in the 1930s. This section was available, and the French government started to impose taxation on U.S. companies, and the U.S. had an ability to try and enforce this retaliatory measure. The Republicans and Trump and the lawmakers have drafted this proposal to now basically say that if a country has what are called, I'm going to call them, discriminatory taxes that are targeted to U.S. businesses, U.S. individuals, then the U.S. has an ability to do what's called a retaliation tax under 899 of the code. And basically, if passed in its current form, would increase the U.S. federal income tax withholding on dividends, on certain types of activity that foreign investors have in the U.S. by 5%. And it doesn't stop at 5%. So that 5% increase starts in 2026, and it escalates every single year until it could be a 20% rate higher than the standard rate. The standard withholding tax rate is 30%. Now, Canada and the US and other countries around the world have tax treaties that can reduce that rate. But if you added 20 points onto a statutory rate of 30% under US law, you may find that the US federal tax rate could increase for Canadians investing in the US to 50%. Add that to state income tax levels, and that means your tax rate could be well over 50%. And this tax would apply to gains on the sale of real property interests by Canadians. If this applied, this would significantly increase the US federal income tax rate, and then you'd have a situation where your US taxes would be much higher than your Canadian taxes, and Canada isn't going to grant a foreign tax credit on excess taxes or taxes paid in a higher jurisdiction. So you're not going to end up with a much higher tax liability. Could this apply to Canadian investors? I think it could. Yeah, the idea is Canada has passed one different legislation right now, something called the Digital Services Tax, which is seen by the U.S. as a predatory measure or a discriminating measure against U.S. businesses. Canada is also contemplating and about to pass a global minimum tax or a base level of corporate tax, something the OECD has been proposing to a bunch of countries, something the U.S. has been against. These two measures are considered to fall under Code Section 899. So if passed, this would have a real concern for Canadians selling U.S. real property. Will it be passed? It's up for debate. I've read some articles that says it's probably going to be passed in its form, even though the Senate is one that respects Canada. Tax treaties around the world, it negotiates treaties. It still may pass. Then it's going to be up to Canada to negotiate with the U.S. to say, how do we best work together so that this doesn't apply or applies at a reduced rate? So it's it's uncertain at this point. I don't know that I'd rush out and do something because of it, because it wouldn't apply until 2026, but it's definitely something anyone in Canada who has real property needs to pay attention to. So lots there. There may be questions on this, and we're happy to answer that towards the end of the session. I think we're at our first polling question. So our first polling question is this: what FERPA rate would apply to a Canadian selling a U.S. property with a value of $800,000? We'll give you a few seconds to consider an answer for that.
Hey, Steve, have you noticed how the US have acronyms for all their big bills? Like there's FERPTA, and then the big beautiful is the BBBA.
Is that what it is?
Yeah.
Our my old partner Warren Duick retired a couple of years ago, and he was always dead set against acronyms because it just sounded like this big alphabet soup. And you may know what you're talking about, but others aren't going to have any idea. And FERPA is one of those ones where you really got to define it. I think I went through and figured out what NASBA was, which is the National Association of State Boards of Accountancy. We want to try and make sure we can speak in plain language that people understand. So absolutely. So excellent. It's FERPA has been around a long time. There's been changes to it over the years, and I think it's one of those things that we see this being having a real big impact. So the answer to the question, because it's a value between less than $1 million and more than $300,000, the withholding tax would be 10%. If that property was sold on over $1 million, it'd be 15%. The Canada-U.S. tax treaty does exist, and it can help clarify who gets to tax what. But the Canada-U.S. income tax treaty won't impact the rate of tax that's withheld at the time of sale. So interesting question there. Appreciate everyone participating there. Annalisa, I think I'm going to turn it over to you for, actually, I got one more slide. I see that. So let's go into some of the common strategies here. And so some of the common things we see when people are selling U.S. property is that they don't consider their ownership structure. There could be some things you can do with your ownership structure as you kind of move into a sale to make it easier to sell and to get that refund. You don't have to have a U.S. taxpayer identification number to sell a property. You may never have worked in the U.S. or lived in the U.S. or never had any interaction. You can apply for that later. It could possibly delay any refunds that might be filed, because at closing, if you don't have a number, then there's a different process that the IRS goes through with the escrow agent to attract or track, pardon me, your withholding tax to your account. It always helps to have that number in advance, and there's ways to get that. We'll talk a bit about mismatches on withholding slip, problems with escrow agencies and how they process things, IRS delays, and we'll talk about just not even filing a complete tax return. All these things can delay that refund request by a long period of time. So I'll turn it over to Annalisa with some of the detail here.
Sure. So we wanted to break it out between 3 stages here. We've got the pre-sale, that's the planning stage at sale, at the closing of the sale transaction, and post-sale. Next slide, please. So planning for the sale, if you're not in the process of selling yet, there's some time to kind of look at the timing of it. It depends. If you sell it earlier in the year, the filing a tax return is actually the next year of January, the end of January. So if you've got some time, there's a possibility of filing for an early refund on Form 8288, but wanted to caution you that also takes some time to file that and have that process. Steve, do you have anything on the time?
Well, it is. Yeah. I mean, the IRS isn't hiring more people at this point. They're not only freezing hiring, but they're laying a bunch of people off. So it's difficult even before, the actions from DOGE and everything else to reduce government employee levels and costs. It took, 8 to 12 months to get this kind of done before. We would anticipate it's going to take even longer. So unless the dollars are significant, it may be something that if it's a sell in the middle or the last part of the year, since you have to file a tax return anyways, you may find just filing and getting your file lined up in order to file a tax return early in the new year is going to get the refund just as fast, if not faster, than applying for a reduction. at time or filing for a clearance certificate, because it just takes so long for the clearance certificate process to get approved.
Yes, that's right. And then Steve alluded to the ownership. If there's any changes that you may or may not be beneficial to you, and there's time before you put it up for sale, and also confirm the owners on the listed owners on the deed and make sure check on the status so that you're ready when you have to certify it's the status. And if you can, file for that US ITIN early. There's some exceptions to not filing with a tax return that we'll go over in a little bit. And of course, get your documents ready. You might have purchased a property 10, 15 years back. So go ahead, find the documents, find any other receipts that you have for any renovations and such that does up the value of the property. Next slide. So at the sale closing, there's just such it's just open to errors that really can be easily looked at. So watch for any incorrect or incomplete information, complete that seller affidavit of foreign status, and confirm that the buyer is aware of their FIRPTA withholding, because it is on them to withhold that amount, the withholding taxes. And the FIRPTA withholding, we've shown you the rates, so maybe that exception is available if the buyer is using that as a primary residence. And a little background on that. I mean, it's 0% because primary residence for the buyer, I mean, they've got an exemption for that for the US, so that makes sense that the US will allow a 0% if the buyer can certify that that's what their intent is. We talked about possibly the early refund if that makes sense. Look at the withholding rates, look at the tax slip details, and match that up to the owners and the identification numbers. And last of all, make sure the withholding agent remits to the IRS, because I have had one occasion where everything was filled out, but it didn't get sent in to the IRS. So there was no withholding that the IRS had. So very important step.
Well, Annalise, you raise a lot of great points there. And the escrow agency, industry in the U.S. is a tough industry. It's a high margin or it's high volume, low margin business. And so, these are exceptions or non-routine types transactions. And while there's a lot of Canadians selling properties, it's still a small percentage of the total. So it's not seen very often. So these steps and forms and closing things, they're different, they're unusual. And our encouragement is, watch very closely what the escrow agent's doing and go through it in fine detail. We've seen situations that Annalise says where the funds weren't remitted to the IRS. We've seen the escrow agents, confuse federal and state. We've seen them confuse buyer and seller. We've seen them confuse, withholding tax and sales price. And anytime stuff gets to the IRS or a state government, and it doesn't match what they're expecting to see, it gets kicked down into another pot bucket department. And it'll delay the processing of your tax return and your refund substantially. We'll talk a bit about what some of those delays mean, but the importance of at close during that process of either yourself looking through these in fine detail, or if you're not sure what you're looking for, having a firm like Andersen help you with this process. This is one of the we've helped a lot of our clients to say, let us spend some time now, because the work we do now at close is going to have a big factor in the success we have of getting that return filed and processed quickly, effectively, and efficiently.
Absolutely. So once the withholding is done, it doesn't end there. You have to file a US tax return to claim that refund. And that's where Steve had mentioned that the US government wants to see what the net gain was on the property. And then you can deduct the withholding that's already been taken off of that sale. Most times you will get a refund, but here, just reminders that you have to file the US tax returns by the due date. The withholding slips, which is the 8288, you have to have a copy of that attached to the tax slips and claim that withholding on the return. And of course, follow up with the withholding agent if there were any IRS issues on getting that remitted, or they amended the slip like after the fact. So make sure you have the right documents on hand. So in terms of the due dates, the Canadians who are non-residents, they have till June 15 of the following year. So if you sold the property, say December 1st, 2024, the due date for that is June 15, 2025. So it is a year after the sale. And in the US, there's an extension available till October 15. States, sometimes they follow the federal, but oftentimes they have different due dates, so watch out for that. And if you can, set up e-file, set up direct deposit or the refund check if you're available. This will reduce the international mailing, and if more often not the postal strikes. And file within 3 years of the due date of the return. So going back to that example, if it was a December 2024 sale, file 2025, 26. So 2027 is the third year that you should, June 15, 2027 would be the year, so that you don't lose access to that refund.
Well, I think that's an important point because that's a statutory limitation is the IRS won't pay refunds after a certain time. There can be exceptions to that, but the idea here is you need to file, you need to retain proof of filing because that's the only way you're going to be able to say that you met the statutory requirements to request a refund.
Right. And just going back one step with the direct deposit, it's usually you have to have a US based account, so they won't accept a bank account that you have in the US. So so that's why if you can set up direct deposit if you have a US based account. Next slide, please.
Absolutely.
Last of the post reminders is you have to file with a US tax number. Can't leave that blank on a US return. If applying, most times, again, we'll have a slide right after this on the ITINs, but if you have a US ITIN and you're applying for it at the same time of the return, that takes time to process. So you might need to wait until you get that federal US ITIN to file the state return.
Well, and I've seen that from time to time, and it's one of those things where you always want to file your tax returns on time. You always want to pay your taxes on time. There could be interest, there could be penalties for doing so. In certain situations, it actually might make sense to wait until you have everything lined up and then to pay and or file. The payment's the one that always concerns me. I'll give you an example. The state of Arizona, if you're not a resident of Arizona, if you're not a U.S. person, sorry, if you're not a resident of Arizona, if you sell Arizona-based real property, there is no withholding tax on sale. But if you have a gain, it'd be subject to tax in Arizona. So if you don't have a taxpayer number, we'd recommend you file a return. But let's say you owed a few $1,000s, or let's say you owed $20,000 to the state of Arizona. What I wouldn't want you to do is to send a check to the state of Arizona without a taxpayer ID number. My concern would be that check will get cashed, but how's it going to be tracked to you? Because the Arizona, Department of Revenue has never heard of you before. They probably have a mechanism, but that could be delayed, and there could be some frustrations trying to apply the payment to that tax return once they match it up. I think what you want to do is a bit of a cost benefit to say, okay, if I file on time, what is the interest charge going to be if I wait 3 or 4 months until I get my taxpayer number, then send that to the state of Arizona, then send the payment in. And if you find that the interest is only a few $100s, that might be the smartest interest you pay, because one, you hang on to your funds a little bit longer, but two, you make sure the state has processed that on a timely basis, as opposed to spending years of letters going back and forth and collection activity, whatever else, because they can't match up the payment. So it's a practical solution to a problem as opposed to technically accurate. You just want to be able to make sure you're doing, I guess, the right thing, but at the time where it can all get processed efficiently and effectively. So.
Right. And don't leave any deductions on the table. Selling expenses, closing costs, those are deductible against your gain. So that would help out. Also, going back to if you made any renovations to the property and any purchases that adds to the cost basis of the property, that's going to help you out too, because the net gain that you take off from the proceeds, it's going to be less. So definitely claim those. Don't forget to do that. And always retain proof of filing. Next slide. So filing a return, still not the end. You've got to follow up with the tax agency. And just a warning, it takes time. I know everybody who's expecting a refund is always wondering where is that refund. And the IRS does have a website on to check on where's that refund. And sometimes it doesn't work with a non-resident because there's no ITIN yet. So be prepared for a wait. And with the staffing changes and shortages, that's increased the delays of processing with the returns. Paper filing, when you can't e-file, that also adds to the time. So yeah, just be prepared to wait, but hopefully when everything is filed and everything's accurate, though that wait is a lot less than if there were some issues. So the IRS doesn't send any notice of assessment. That's unlike CRA, unless they find some errors and discrepancies, and they will write. They will not typically call or email you, so watch out for that. It may not be the IRS calling or emailing you. And then for the IRS transcript, which is their version of the notice of assessments, you have to request it. And the transcript is at the federal level and the state level. So that's two agencies that you've got to follow up with.
So, Annalisa, on that, why would a Canadian want to request a transcript from the IRS of what was processed? What would the importance of that?
Well, it's CRA has been following up on the foreign tax credits that's been claimed. It's not enough to claim the withholding tax against a gain on the Canadian return, because that's not the final tax. That's a withholding on gross. So they're looking for the actual tax that you paid in the US, and how doing that, you have to calculate the tax in the US. You have to file a tax return in the US, and you've got to get that transcript. And that's what we're seeing. Like CRA is sending out letters after the fact. Please give us the proof of filing for your foreign tax credit.
Well, I think that's just it. Is Canadians have to expect that if they sell a U.S. property and there's a gain and there's a foreign tax credit, that there's probably a 3 in 4 chance. There's a high probability that not your entire return is going to be audited, but you're going to get a letter within 30 days after you file, and Canada Revenue is going to say, "Hey, we see that you claimed a foreign tax credit. Tell us more about it." And as Annalisa says, this is the proof. It isn't just a copy of the federal tax return, because the Canada Revenue would say, well, that anyone could kind of make that up. We want proof that you filed it. We want proof that the IRS assessed this and that it matches what you filed. And there's a timing, concern over here, because Canada Revenue is efficient at getting those letters out, usually within 30 to 60 days of you filing the tax return. But the IRS has some delays when they process these tax returns, and it could take some time to issue those transcripts. And so this is an important step of this. This will be new for Canadians. Some Canadians never get any letters from Canada Revenue at all, so it could be a little upsetting or concerning to get it. It's routine. It's part of the process. You just got to be prepared for it.
Right. And if there's more of a delay than expected, involve the taxpayer advocate service that the IRS has, and involve your accountant with a power of attorney to act and contact the IRS on your behalf, and respond to all notices as soon as you can, because what I've seen from one instance was an agent would send you the letter and then there's no response, but then you respond like 60 days after. Well, your file went to the bottom of their list. So that's why respond as soon as you can.
Absolutely. And before we get to our polling question here, just on that topic, if you want to go back to the last slides there, in the top right corner, it's the IRS logo. And I get that it's intimidating and people get worried and nervous about selling property in FERPA, and they try and do all sorts of things to try and get out of it. I've been doing this for decades. I've never seen a situation where the IRS didn't eventually pay the refund. It might take a year, it might take 2 years, and that's frustrating. I get that. But in every case, if it was a legitimate sale and the tax got paid, it always gets wrapped up. It always gets paid back to the seller, it's just a process, and you just have to, go through it. We're giving you kind of some tips here to try and make that quicker and more efficient. Uh, I wouldn't, I would, encourage people that this will get done eventually. It just takes time. Why don't we go to our polling question there? Go ahead, Lisa.
Sure. So polling question number 2, which of these situations will delay the processing of your tax refund? A, not filing your US tax return. B, FERPTA withholding slip is 100% in the name of only one joint owner. C, your US ITIN application was rejected. And D, all of the above.
And when we talk about those delays of being a year to 2 years, there's a chance that gets longer as the IRS freezes hiring and reduces their staff count. And these are the important things by lining everything up, from having your a U.S. identification number part of the closing documents, getting the closing documents correct, filing the return early in the new year, or even sooner if you have the ability to do so, depending on your structure. Electronically filing the return if you can, having a direct deposit of your refund into a U.S. bank account. All these things, when done properly, we've seen our clients get refunds within 45 days as opposed to 18 months to 2 years. And so the importance of, spending a little time and effort to try and do this is there. So I think everyone kind of sees as the polling question results that yes, any one of these things and other things can delay the processing of the refund. So thank you for that.
Next slide. So we're going to go over some pointers on the W7 ITIN application. So the form is Form W7 ITIN application. It's for applying for a new ITIN, a US ITIN, which is the individual identification number. Or if you're renewing an ITIN that expired, that's also the same form. So the ITIN is something that taxpayer applies for if they're not eligible for a social security number, which is the SSN. So I think maybe we have a slide before this, Carmen. Okay, there it is. Thank you. Most cases, the W7 is applied for with a tax return. They process it at the same time. However, where you can apply beforehand, there's some exceptions for that. For example, when you're selling the property and withholding has to be taken, W7 can be applied for so that the withholding can be matched up to a US ITIN, so your account in the IRS instead of like a foreign account that's much harder to trace. As in any tax returns, if it's incomplete, the form, it's going to cause rejections and delays, because then you're going to be doing it back and forth. Oh, your ITIN application was rejected, and then you have to reapply again. So best to get it done the first time. Next slide. So with that W7 form, the application, you also need to send in proof of your foreign identity and a status. That's best done with a Canadian passport as proof. Don't send the original. It's probably going to get lost. And there's other documents that allowed, but it has to be a combination of both, because the passport confirms both the identity and status. But if you got corroborating driver's license, birth certificate, there's a list that the IRS has. But the Canadian passport is best. So, but that has to be certified, because you don't want to send the originals. That copy that goes to the IRS has to be certified. It used to be the Passport Canada would add a seal to that, and IRS would accept that because Passport Canada was issuing agency. But not anymore. That's from recently. We have seen applications rejected because of that. And then the public notarized documents are definitely not accepted. The IRS is allowing CAA, the certifying acceptance agents, to certify that copy of the passport to send in with the W7. I'm a CAA, so is Steve, and we have one other person that can help with that. And we would set up a meeting, look at the original to the copy, fill out this W7 for you, and get that sent in with the filings. Okay. Other reminders. Lastly, ITINs do expire after 3 years, or if it's not used. That's why if you think you had an ITIN from 10 years ago, it's probably expired. So you need to reapply again on the W-7 with the new passport copy. The processing time can be 6 to 8 weeks or more. There's a letter that the IRS issues to you with that ITIN. Keep that. And then when you file that return, you can use that ITIN.
Go ahead, Annalisa, on our final question. Go ahead.
Sure. Our last polling question here is, which statement is incorrect? A, the Canadian passport is an accepted proof of status and identity for Form W-7 ITIN application. B, US ITINs can expire and must be renewed. C, Notary Public certified copy of the passport will be accepted by the IRS. D, only A and B are incorrect.
And there's some good questions that I can see in the Q&A section. I'll try and address a couple of them quickly when it comes to these numbers. If you worked in the worked in the US before and you have a social security number, it's still valid, more than likely. So you should be using your social security number. You don't need to apply for an ITIN, and in fact, you shouldn't apply for one. So if you have a social security number, it should be valid. As Annalisa said, if you had one kind of 10 years ago, it's probably still there, but needs to be renewed, and you need to kind of go through that process. If you are doing it, it can take kind of 6 to 8 weeks, as Annalisa said, to kind of get that number. The biggest thing is you can't just apply. You need to have a reason. A tax return is usually a reason. There's about 7 or 8 exceptions, including selling real property, but you got to provide information with your application as to why you're applying for that number or why you're renewing that number. Absent that proof, it'll get rejected. And so, we see this. We work with the IRS on these things, and we see this often. So, it's an important step to make sure we can kind of do this. So, if I remember the answer to this question, the Canadian passport is correct. The ITINs can expire and must be renewed, and therefore I believe the answer is C. A notary public certified copy of the passport will be accepted. They won't accept a notary. It has to be a certified acceptance agent.
Great.
So next slide then. So we're at time here, and so we've left about 12 minutes for questions, and we got no shortage of them, so that's terrific. What are some of the takeaways here? Where you can, plan ahead for the sale, and that can get everything lined up as we talked about before. To get your documentation together, to calculate your capital gain or loss, think about it in US dollars, think about it in Canadian dollars. One of the things that catches Canadians is that it's taxable in Canada. The gain is going to be taxable in Canadian dollars. Doesn't matter what the US dollars are. And so you can have situations where not only is the gain taxable in Canada, but the foreign exchange difference. So if you bought 12 years ago when the dollar was at par and you're selling tomorrow when it's $1.40, that spread is also taxable in Canada because you have a Canadian dollar lift as well as the real gain. File for your tax IDs early if you can, and just Andersen can help you with this. We're working with our clients and prospects quite often with sales of property, and we can work with you anytime, whether it's 3 months before sale or whether you've already sold and you don't know a lot of these things that happen. We can still kind of help you with this process. So we're happy to do that. We have a bunch of questions in here. I know we had some questions before, and Nicole and our team, if you want to kind of jump in and pose 1 or 2 of those questions, let's start with those.
Sure, you betcha, Steve. Thanks so much. The first question we have is, our US home is registered in our names. Should we change or add our kids who are in their 30s? And do we handle this in our will or alter ego trust?
Sure, lots there in that question. I just want to address one point of that, and that's changing title. I think the concern we always have when people change title in the US and add owners is that a sale both for US purposes and Canadian purposes? You've put someone on title. Have you sold an interest on that? So if there was 2 people and they had 2 kids and now there's 4 people on title, did that family just sell a quarter interest of that property? If they sold a quarter interest, now you have US federal tax, you have state tax, you have FERPTA withholdings, you have Canadian tax on that. So that's a concern. The other one is, even if you could argue that there's no sale, because it's just kind of done in trust or on title or something. The other concern would be from a state or local tax perspective, what does it mean when you change title? And you'd be surprised what some states will do when there's a title change. My understanding is in places like New York, where they've started to implement what they call millionaires taxes or property transfer taxes. Those property transfer taxes can be significant when you change title. You can also see it happen in the state of California, where all of a sudden, if you've changed title, there can be state levies, there could be a property tax change, your property taxes could be increased. So you need to be able to really think through whether that makes sense in order to move that forward. So in general, I'm not sure I would do it on that approach. There may be other solutions there. Other questions, Nicole?
Sure. Another one that we received was, how does the Canada-US income tax treaty impact Canadians selling US vacation property?
Sure. So the Canada-US Income Tax Treaty is a treaty that governs transactions between the two countries. It'll generally confirm that the sale of US property, the sale of any real property, is based where that property is located. And so if a Canadian is selling US real property, that means that the US federal government would get to tax that gain first. It means that the Canadian government gets to tax it later, but the Canadian government has to allow the US to tax it first, and then has to effectively grant a foreign tax credit. The Canada-US tax treaty is not going to eliminate withholding taxes on sale. It's not going to eliminate the need to file, but it will govern. It will govern that as well. So let me go through some of these questions here. There's some really good ones here. A lot of the numbers we used here are in US currency. So when you're selling that FERPTA, and Annalisa, what were the numbers again for the different changes in rates for the FERPTA withholding?
300,000, under 300,000 was 0%, and 300,000 to 1 million was the 10%, and above that 15.
Right. And so those are all in US dollars.
Yes.
We run across this from time to time, where someone who lives in Canada is selling US real property, but they're a dual citizen. They're a citizen of Canada and they're a US citizen. And so then the question is, would they be considered a foreign person subject to the FERPA withholdings, or would they be considered a US person? And the answer is, they're a US person. They're a US citizen. And therefore, when they go to close on the property, they should be representing themselves to the buyer that they are a US person. There's usually a form that they complete that outlines, that affirms that they're a US person. Here's their social security number. And then there would not be any US federal income tax withheld because they're a US person. The closing documents would probably produce an IRS tax form that would list the gross proceeds allocated, and that would then, compel that person to include that transaction on their US federal income tax return. They may still be subject to state withholding, because unless they're a resident of the state when they sell, they would still be subject to state withholding on that. So one of the questions that's in here is how are cost bases calculated when reporting the gain? So a cost basis, Annalisa, you talked a little bit about that. How would you calculate your cost basis for US tax purposes?
Well, that from the purchase document, take a look at that. It's in US dollars, but you have, for when you calculate for Canadian, we got to go back to what the spot rate was on that date. So that's going to be different. In 2008, it was fairly close 1-to-1, but right now we're seeing a 1.4 difference. So that makes a lot of difference. Also, in addition to the cost basis, is if you paid something, take a look at that purchase document. There's some amounts there that can add to the basis. So that's something. And if you've added to your property, some major renovations, that adds to the basis too.
So anything that's capital in nature, if it
Right.
extends the life, that would add. You're going to have commission costs, you're going to have legal costs, you're going to have other accounting or advisory costs. Those are typically deductible against your sale proceeds, so that reduces the capital gain on sale. There was a question here about filing taxes, and I wasn't sure whether that's a US citizen or not. Let's say it's a Canadian person, Canadian resident, not a US citizen, who sells a property in the US and they haven't filed US tax returns before. Well, if you never use the property as a rental, if you just use it as personal use, you probably wouldn't have had any reason to file US tax returns in the past. So that year of sale is when you might file the US tax return to report the gain. But if you did rent out the property, you have an obligation to either pay a gross tax on the rental, and that's usually 30% of the gross rent, or you should be filing US tax returns to report your net income from the property. So you pick up your gross rent, you deduct your running costs, which could be everything from mortgage interest to property taxes to condo fees, repairs and maintenance to insurance. And then you would and claim depreciation as well, which you're forced to do in the US, and then calculate on the net. And that's an important piece to do. You can file those after the fact as you sell the return, but that's an important thing to do because you've used it as a business and your cost basis will change and you may have losses from that rental activity. So we got time for a few more questions here. There's a question we get often about timeshares, and people have had timeshares all over the US. And what's the consequence of that? Well, a timeshare is an interest in US real property. So a sale of a timeshare, all these rules apply. If there's a gain on sale, it's subject to US federal tax. It could be subject to state tax. It's subject to withholding. The question here is, if there was no withholding, what would one do? Well, it's an interesting one. I mean, the fact that you're able to sell without the withholding, I think you probably got away with something, because there should have been if it was a $40,000 sale in this case, there should have been probably a 10% withholding. If it didn't happen, that's probably on the buyer to do something about it. And if the transaction's long gone and closed, I don't know that that's going to come back on you. You have an obligation to file a tax return to report the gain. If you sold it for $40,000, my guess is the gain is going to be at most probably $35,000 or whatever you paid for it. So my guess is there's no US federal income tax on it anyways. But you do have an obligation to file to report that gain, even though there may be no US federal tax. There's a couple more questions I want to get to here. One of them is just the turnaround on the W-7 applications. We talked about that usually being kind of 4 to 6 weeks. That we haven't seen slow down this year, even with all the hiring freezes. So hopefully that'll help. The certifying acceptance agents, how does that work? And I think that's an important question, because we've been doing this for probably a decade now or so. We need to see the passport. We can't just see a copy. We can't just see a scan. We can't just see a photo. We physically need the passport. We don't necessarily need to see you in person. We'd love to have you come to one of our offices and sit down and go through that. But if it's remote or if it's travel, that's fine. We do have to get you on a Zoom or a Microsoft Teams or on a video conference, and we'll literally, have you courier the passport to us. We'll look at it. We'll hold it up to the screen when we're talking to you to verify that that's you, and verify that we've seen you, and then we'll courier back the passport to you so that you're not without it that long. So we don't have to meet with you in person, but we do physically have to have your passport. There's a lot of questions here, and I apologize that we haven't got time to answer all of them. We're just at the top of the hour. I want to thank everyone for their time today. Great to have this timely topic that we talked to you about. Annalisa, thank you for joining me today. I appreciate that.
Thank you. Thanks, Steve.
And we encourage you all to complete the survey that we'll send out. Tell us how we can improve. Tell us what other topics you want to see. And again, thank you all for attending, and we wish you a good day.
Thanks, everyone.